how can we make sure that our borrowers are educated so they understand. And that's part of what I wanted to talk a little bit about today. But also the other thing that's just really exciting is their changes. And I don't know if you can talk a little bit about the resiliency score, because there are a lot of people through the pandemic, they ended up, some people took a break and didn't pay their mortgage for 2 years.
Welcome to the Jennifer J. Hammond Podcast. Jennifer is a licensed realtor, educator, speaker, and best-selling author. Jennifer's goal is to help you find your yay in every day.
We are now going to be live on YouTube. Yay!
Yes.
Oh my gosh. So, of course, I was just saying before you arrived here that you and I have known each other for 8 years and been on, obviously, Sirius XM radio. You've been on my podcast. You've been on the live streams. We've been in Clubhouse. But I finally got to meet you in person this week, which was so much fun.
No, that was amazing. And to be able to do it at FICO World, right? Which is kind of the mecca of my business. And you came down, and also we were able to meet Erica for the first time, who literally produced your show for years.
She's always been like my PR. She started in her 20s as an intern, and now she's doing great. And she is in Clubhouse today. So you can say hi to Erica. Yay!
Hey, Erica.
So let's talk about FICO. Go ahead.
Yeah, forgive my voice. That's part of the reason why I came home, and I was just sick in my hotel room. So, but this is, I thought you always have to take precedence and priority. Jennifer, I will climb out of my hospital bed for you.
Oh my gosh. Well, thank you. And it's so fresh off the I want to say hot off the press, because you just went to FICO World. So I'll talk a little bit so that you don't have to do all the talking. But so number one, the coolest thing, I think, the FICO World is even getting to experience it for just a little bit. I had such a fun time seeing all of these different financial entities coming together and looking at, so how are we basically, and I'm just going to say it felt like going to Oz, the Wizard of Oz, and going behind and peeking behind the curtain. Like, how does the credit score, how do they score you, and what are they doing with FICO, and how is that going to impact your ability to get funding? But they're really changing the models. And again, you haven't even had a FICO World since 2019, right?
Correct.
So it's been 2 years, and or a little over 2 years. And I think the thing that's really interesting as well with FICO World is, of course, the business banks are really looking at how can we make sure that our borrowers are educated so they understand. And that's part of what I wanted to talk a little bit about today. But also the other thing that's just really exciting is their changes. And I don't know if you can talk a little bit about the resiliency score, because there are a lot of people through the pandemic, they ended up, some people took a break and didn't pay their mortgage for 2 years or for a year or for a certain amount of time, either because they lost their job or their business just completely, like even people who were doing short-term rentals as Airbnb hosts or stuff, people weren't traveling. And so their income just went down to zero. And it was pretty scary, I think, for a lot of people. And so now they're getting back into the workforce. People are traveling again, just like you coming to Florida. People are traveling again. And so there's this thing called the resiliency score. So will you talk a little bit about that?
Yeah. So the resiliency score, 2019, this is one of those kind of, I call it a miracle or call it, I don't know, prophecy or something. But it was November of 2019 when they introduced the resiliency score. Literally March, 4 months later, they start needing that resiliency score because of the fallout you just shared, right? And so resiliency score is based on the title of the room that Sally Stone was the VP of scores. The title of the room was called "Which of Your 690s Are Going to Succeed?" And I thought I was fascinated by the name I was fascinated by the name because there's the FICO score, but then there's this range. They're called buckets or scorecard, and a scorecard may have no negative, no 30-day lates, no delinquencies, no bankruptcies, no nothing. But they may always carry high balances, or they may always not pay on the first. They may pay on the fifth, never 30 days late, but they'll pay on the 5th or the 10th, right? They may have too much debt. And so the resiliency score, which is different than the 3-digit FICO score, the 3-digit score, the resiliency score was what take my score, and then how long can I last before I go delinquent? Because the normal 3-digit score predicts 24 months out. What's the likelihood of going serious delinquency, which is 90 days,
right?
Serious delinquency or bankruptcy in the next 24 months? Well, the resilience score shrinks that down to 6 months. And so that's what they started measuring, is how close to falling off is somebody. The moderate to middle is 50 or below. If you're it goes to 100. If you're 50, 55, you're okay, right? But if you start going over 50, higher and higher, the likelihood of you not lasting through a personal or national financial tragedy plummets, right?
Right.
And so it is different than the 3-digit score, but it basically shrinks it down into 6 months, not 24 months, that you might go into default.
And so I think that it's really important to understand that I think a lot of people, when they were taking a break from their mortgage and taking a break, even I know a lot of credit cards also allowed you to take a break and not make payments for a certain amount of time during the middle of the pandemic. Now I don't know if there's an official end, or just the fact that, business is much more getting back to normal. Obviously, nothing seems normal. And I don't know if there's I use my air quotes, a new normal or not. But the one thing I know for sure is that we're seeing that it all seems like it's definitely changing how they're going to look at you, on whether you're somebody they want to believe in and think, oh my gosh, this is a person we want to lend money to, whether it's on business credit or whether it's personal. It's very, very different. So as you went to FICO World this past week in Florida, one of the things I'm curious if you would share a little bit about, what is the theme that FICO World was really, because they always seem to have a theme every year. And obviously they haven't gotten together in over 2 years. So what was the theme this year?
It was about preparing for constriction, right? The market, so credit markets, and what I'm going to use my terms because they use terms they use terms like optimization for lending risk, right? We call it the target is shrinking. So if let's say you have a large target in financial prosperous times, that target is going to be, you can get funding. Now, the further out on the target you go, you're going to get higher interest rates and lower approvals, right? But if you are, in fact, I'll just bust it out here.
There you go. We got the whiteboard. Anyone who's watching on YouTube, we got the whiteboard. Oh, I love it.
So in prosperous times, you've got a big target area, right? And so if you're hitting out here, it's going to be higher. The outer rings is higher interest rates, lower approvals. And for those people who still get in here, it's at lower rates and higher approvals, closer to the bullseye you are, right?
Yeah.
Well, what FICO was talking about is that everything that's going on right now is that the target is moving in, and it's only going to be a small target.
Yeah. And
so they're saying, as lenders, how do you, and it's amazing to hear what we do be presented for, and you were there, you heard some of it yourself. What we're doing at Get Fundable is we optimize borrowers so that they are bullseye borrowers. They hit the bullseye on the target so that no matter what the size of the target is, you're always fundable. You can get approved because you're as close to that bullseye. I don't believe there's going to be a massive constriction of credit policy, but one of the big takeaways that I got, and you met David. David and I are just fast friends at this point. David is one of the managers of the business originations department, meaning new credit for businesses. And he basically said that the first and most powerful of all policies for lenders is to reduce, if somebody is let's say you have a $20,000 credit account, a credit card, if you're only using 5,000 of that, 25% of it, if you're only using 25%, they're going to reduce you from 20,000 to 10,000 because it's called fractional reserve lending. The Basel II, the agreement among worldwide, the agreement among banks, says that you have to keep anywhere between 10 and 15% on your books to be able to loan money, right? So right. If you're going to loan $100,000, you have to have $10,000 in your asset base. Well, interestingly enough, that if they take it away from somebody who's not using it, they can continue to give it to new bullseye borrowers. Mm-hmm. And so we feel, and that was a huge revelation for me. Originally, I was of the opinion that they were just constricting it so people wouldn't charge up and use it. But you've proven over your what's called trending data, we call it your 24-month look back period, you've used only $5,000 of your $20,000 on average for the last 24 months. That credit is not doing anything for them. And so they want to reduce your credit limit so they can give that other $10,000 to somebody else who will use it who's a highly fundable borrower. Massive revelation for me and shift in financial credit policy.
So think about that, because that's a huge difference. So in a weird way, I mean, we talked about even just sharing, I've had clients who talk about the fact that, they had credit cards that if they weren't using, they just got them closed. They went to use them and they maybe got to charge one time. And then the card, it's almost like it brought it to their attention that, the card wasn't even being used. So it got closed, or it just wasn't being used and they closed it. So it's funny because it feels like they're definitely contracting the amount of credit you can have. But also, like, if you have a balance, they're like totally fine with you keeping it, and you can keep a huge, like $30,000 on one card, no problem. But if you pay it off, then they're going to drop your credit line down to as low as they can possibly get it. Because again, like what you just said, and I didn't realize that was why, because it was just so weird. I was like, why are they doing these crazy things with, and I think we talked about a little bit, the policies have just changed so much. And again, when you call and talk to people, they're definitely not, even when you call and talk to credit card companies, they're not that knowledgeable on the why. They just know that, sorry, it's closed. And you're like, but I have great credit. I have an 850, and they're still, again, closing cards if you don't use them, or if you only use them once in a while.
Correct. And that it's fascinating because with this credit policy, then if we want to have the highest amount of use is, like you said, they're going to drop for every payment you make, they drop your limit, right? And they're just going to follow or chase your balance all the way down to something manageable, 5,000 instead of 30,000 in your case.
Which also thinking about, you and we talked about this a lot. And I know in your boot camp, you talk about it a lot as well, is that, if somebody's chasing your balance down like that, then you're getting that really high ratio. Because before, when you had 5,000 and your limit was 30,000, then you're only using a small percentage wise of your credit card. But as soon as you're using the whole 30,000, it's obviously it's a high utilization, and that really counts against you. But if they keep again, this is where if you don't understand the rules of the game, and they're constantly changing the rules of the game with credit, if you don't understand it, it can really bite you because, again, not understanding that those high utilizations start to, again, give you bad behavior. You're getting bad behaviors as far as, the banks and the credit cards and all credit is looking at you in a negative way because of high utilization, right?
Yeah. Yes. And that whole process of keeping you at 95% utilization for as long as it takes you to reduce those limits, that could be months or years, right? And they're still going to keep you at high utilization. We asked the FICO score team that very question. We're like, so what happens if I'm paying my bills off, but they're lowering the limit? And said that's what the resiliency score is there for. Because if your regular score is hit because of high utilization, but it's going down, the resiliency score counts the amount of debt towards it. So you might be all green. You have a very high resiliency score, but your FICO score is low. So that's why they built it. Now, the other thing that's fascinating about that, Jennifer, is that when we were also told at FICO that I asked them the question, well, some people get their limits lowered below the balance. What's up with that? I've got 20,000. I got $15,000, 20,000 limit, $15,000 balance, and boom. Now I have a $10,000 limit. I'm over limit by $5,000. What do you do about that? And he's like, again, that's the resiliency score, but we can't help what lenders are doing to protect or rearrange what credit is available. Some of the credit department may be making a decision. We need as much as possible that is the average utilization. Maybe we hang out at 5,000, 6,000. They're like, take them down to 10. Let's free up that money to lend somewhere else. But because we happen to go over to 15, then now we're in trouble. And they said that's what the resiliency score is for. But just so you guys know, even though the system is doing it, they're an over limit almost as bad as a 30-day late. An over limit is almost as bad as a 30-day late. It's the cousin of a 30-day late. And so we get hit. If we don't know how to play this game, we're going to get hit by the score model. The resiliency may help us, but here's what sucks. The resiliency score is just a score developed by FICO. It has to be licensed and used by lenders. Right. So are you with a lender who licensed it and is even using it? So we got another problem there.
Yeah, and that's like the thing we've talked about, I know a lot of times before, and that is that FICO also has different variations of the software, which is very similar to what you're describing with the resiliency score, is that it's very different on which model they're using to judge you basically on and what aspects are important. And, we've talked about that on some of our Facebook Lives that we do on Wednesdays. I think it's really important for people to understand that, again, the more you can understand who you're dealing with as far as, the bank, the credit card, the auto financing company, whoever it is that you're working with, what are they working with? And again, I pinned at the top, if you're in Clubhouse, I pinned at the top the boot camp link. And, this is something that I know you go into extensive. We've got about 30 minutes left here. but I definitely want to open up the floor. If anybody has questions, you guys are more than welcome to ask questions. I always have a gazillion questions for Merrill, so I can go on for hours, but we won't do that, especially since his voice is he's really pushing it. Oh my gosh, I'm so grateful that you're here, because I definitely
always for you, Jennifer.
Thank you. Yay! I think it's so important that we get this information out in a timely fashion, which is one of the reasons that I was so excited about, right after you got back from FICO World. And I know you had different team members down there. A big shout out to Jessica. She does amazing. She's just an amazing asset to the team. I love her so much. She's so incredible. And I know she also has attended some of the stuff that's out there. So let's talk a little bit more about kind of what's the latest and greatest with FICO World. What can people, kind of looking forward, what do you think is going to be some of the biggest pitfalls that people might be coming up against especially as businesses? What are the things that they need to know?
All right. So let's talk about, again, David Smith was on my podcast and we had a blast. Like a brother from another mother. This guy's hilarious. And he introduced us to other members of the originations team. And coincidentally, we knew them from there was Glenn and Tina and Sari, I always get her name, Swatiri. These are brilliant mathematicians and engineers. And I bring that point up because they're consistently working on SBSS, which is Small Business Scoring Service. And there are over 50 banks of the top tier banks that use this SBSS. Now, SBSS is a score that pulls bureau data from TransUnion and pulls Experian and Dun & Bradstreet data for your business, pulls them together and builds a report. They're right now, they're working the landscape for the future is that they want to create ultimately a myfico.com for businesses. MyFICO is where you can go get all of your scores, all of your borrower behaviors, everything. They're working on implementing that. And I don't know what the timetable looks like, but the entire work group is devoted and dedicated to build this business, myfico.com, where you have access to all the business data about how fundable you are and the business data. And there was and consequently, I don't know if you know this, Jennifer, but they made me sign another NDA while I was out there because they wanted to let me know that they're thinking of borrower education as part of this entire thing. So they kind of let me even further behind the curtain and, be still my quaking heart. It is so amazing what they've got coming down the pipe, you guys. And we're going to be right there. We're going to be right there to serve you as business owners and as entrepreneurs.
And this is, I think, something that's so exciting. One, the NDA means that you have access to all sorts of confidential information. And I think it's beautiful because part of your purpose is to educate people so that they can win at this game. And again, the game of funding, the game of credit, the game of being able to get money whenever you want it, that flow of money, to make sure the money is not stopped, to be in the middle of the target so that you are the most attractive, I want to say the sexiest borrower for Absolutely. These lenders so that they just throw money at you. You want them to throw money at you. And to be able to be sexy to the lenders, you also need to understand what they find sexy. And that's part of the borrower behaviors that we've talked about, not only on the personal side, but also on the business side. And that's why the education is so critical. And I love the fact this to me is such a good sign. And I don't want to say a good faith effort, because before I feel like, I keep making it like the Wizard of Oz, like peeking behind the curtain at the Wizard of Oz. And part of the reason I say that is because I think there's so many things where we've been taught one thing and then that's not true anymore. We're taught something and then that's not true anymore. And then we're taught something else and then that's not true anymore. So you have to constantly keep up with it. And I mean, as you know, there is a universal principle that nothing in this universe ever stays the same. So now it's a matter of how fast can we keep up with what's happening, because the banks are having to, again, with everything that's happened worldwide because of the pandemic over the last 2 years, financially, it has impacted so many different aspects of banking and financing, the car industry, you name it. It's affected in money, in the flow of money in such a different way. And even how the governments have been flowing money out. It's so different than it ever was before. So we have to understand, what is it that we should be doing? And also, what is it, we've talked about before, paying, and you just kind of alluded to it earlier, paying on the exact date, then you have paid as agreed. That's what it's reported. Whereas if you pay early, it doesn't necessarily say paid as agreed, even though I still believe that you should get bonus points for showing up early or for paying early. And I mean, and the funny thing is when I first met you and you said that, oh, you needed to pay on the date of something, if it was due on that day, I used to just dismiss it because I was thinking, you got to be crazy. If I call and I talk to them and I say, okay, look at the last 2 years, I have paid early for the last 2 years, and what I realize again is as you call, and it may be the customer service person who is in India, they could care less that you paid early. Again, it goes back to a computer algorithm that is judging you one way or another. And so you have to understand the computer algorithm is a 0 or a 1. There's no maybe. There's no stuck in the middle.
Correct. That's the best way to describe it, Jennifer. The whole point of the algorithm is exactitude, right? Fastidiousness. They did you pay on the due date or not, right? And then there are degrees. Did you pay on the due date? If you paid early, we think the customer service rep, like you're saying, should take account of that. Like, yes, you're a super borrower. You make your payments early. No. The algorithm says on time, not on time, right? And then there's another part of it, late, not late. So you could didn't pay on time, but not late, which means it was early. But now you have two negatives in your not late and not on time.
I mean, that's ridiculous. I mean, and that's being early. Again, I've said it before, but I always thought being early was good. Whether you show up to class early, whether whatever you do, if you do it early, it's a good thing. And I think what I've realized is that, again, if you don't know the rules of the game, then you're going to lose.
Yeah. And to that point, remember that what they're looking at in that algorithm is fastidiousness. And if you are paying on time, the best way to get credit for paying on time is through letting them auto draft or auto pay, which adds more control to the lender than if they're just waiting on you. So if you are on auto pay, you're getting, let's call them bonus points. But the issue is that the system inures to its own benefit. So they're saying, how do we get more control? Well, let's give them more points if it's on time. Well, the easiest way to make it on time is through auto pay. Well, we win double there. So the benefit, it does inure to its own, the system inures to its own benefit, right? So there are things that, and that's why the boot camp, that's why we do such a heavy dive into all of these pieces, so you can at least stop stepping on the landmines that are blowing up all your future funding opportunities.
The rest of the conversation, tune in for part 2 of this interview.
Hi, I'm Jack Canfield. You may know me as the co-author of the Chicken Soup for the Soul series. And if you want more help in getting from where you are to where you want to be, I want to encourage you to listen to the Jennifer Hammond Show.